Okay, let's unpack this. For years, small modular reactors, SMRs, they've kind of felt like the future, right? Always just over the horizon. But the sources we're digging into today, specifically this Q3 2025 presentation from Descale Power, well, they suggest maybe that horizon is finally here. We're not just looking at, the usual quarterly numbers. We're looking at the actual contracts, the financial setups that are meant to take this tech from concept to, well, massive grid deployment. So our mission for you in this deep dive, get past the headlines and understand the strategy behind it all, how these deals work, why the money side is structured this way, and what facts really signal that the SMR industry might be crossing a big threshold.
Right, and that context is really key. We're looking at an earnings presentation dated November 2025. It covers strategy, operations, finance for Q3. And, for anyone listening, especially if you follow high growth markets, you absolutely have to keep the forward-looking statements in mind. It's standard stuff, but crucial. It just reminds us that, yeah, these announcements are exciting, but success hinges on things outside their direct control. Like, can they keep raising capital? What about politics around nuclear? Is the market really there yet, even with these big deals?
That sets the stage perfectly. Okay, so let's jump right into the biggest news here. That announcement from September 2nd, 2025, it involves the Tennessee Valley Authority, TDA, and a company called Entra1 Energy. And this isn't just another contract. The source material calls it the largest SMR deployment program in U.S. history.
It is historic. And the scale, we really need to grasp the scale. The total capacity they're talking about is up to 6 GeW. That's gigawatts electric of totally new nuclear power.
6 GeW, that's immense. What does that translate to in terms of actual reactors, the modules themselves?
We're talking about deploying approximately 72 NuScale power modules, NPM 72. And these aren't all in one spot. They're planned for up to 6 Entra1 energy plants spread across the TVA territory, which, as you know, covers a huge area. All of Tennessee, bits of Alabama, Mississippi, Kentucky, Georgia, North Carolina, Virginia. It's a massive footprint.
So it's not just one power plant. It's a whole regional strategy.
Exactly. And putting 72 modules in perspective, that's approaching the kind of numbers France built over decades in their big push. It's a generational infrastructure project, really. And the reason NuScale is in the lead here, according to their presentation anyway, is that competitive edge. They're the first and only company with a Nuclear Regulator Commission-approved SMR design. And, crucially, modules already in production for commercial use. That NRC stamp of approval is everything. It's the ticket to play at this scale.
Okay, so NRC approval gets you in the door. But 72 modules, that takes serious cash and, well, a smart way to manage the risk. Let's shift from the sheer number of modules to the how. How are they structuring this financially? This brings us to that partnership milestones agreement with Entra1, signed back in August 2025.
Right. This agreement, it's really the core of how they plan to roll this out. NuScale agrees to basically contribute funds to Entra1, but it's not just a lump sum. It's payable for each module tied to hitting specific project milestones. They've set up this 3-stage payment system. It ties NuScale spending directly to actual progress and, importantly, to points where risk gets transferred.
Okay, let's walk through those milestones, because this is where you see how they're trying to, well, de-risk this massive undertaking.
Absolutely. So milestone 1 is 15% of the contribution amount that gets paid pretty early on, just for executing a term sheet, an MOU, LOI, a basic framework agreement. It shows initial commitment.
15% just for a framework.
Right. Then milestone 2, this is the big one, percentage-wise anyway, 35%. This payment is triggered only when a binding power purchase agreement, a PPA, or some other energy offtake agreement is signed.
Wait, hold on. Milestone 2 needs that PPA. For listeners maybe not deep in energy contracts, why is getting that binding PPA so critical? Why is it worth more than double the initial payment?
Because the PPA is the money stream. It's the guarantee. It means a utility has formally, contractually committed to buy the power from that specific module, usually for a long time, at a set price. Before the PPA, you've got a plan, maybe some land. With the PPA, you have proven demand, you can get project financing, you have predictable revenue. It's the point where the project stops being just an idea and starts becoming, well, bankable.
Got it. That makes sense. So PPA secures the revenue. What triggers the final and largest piece of the payment?
That's milestone 3, the remaining 50%. This comes when the OEM agreement, the original equipment manufacturer agreement, is executed. That's the formal order for the actual NuScale power module itself.
So 15% for intent, 35% for guaranteed revenue via PPA, for 50% for the actual hardware order.
Precisely. And NuScale argues in the presentation that this structure is designed to be repeatable and scalable. Right, you can use it for multiple projects at once. It's meant to catalyze commercialization, show a clear funding path, and maybe critically, it gives supply chain partners the confidence they need to invest and ramp up their production to meet this demand.
Interesting. But playing devil's advocate for a second, paying out 15% just on a framework agreement, isn't that still a risk for NuScale? What if the politics shift or the utility gets cold feet before they even get close to a PPA?
That's a totally fair question. And yes, there's inherent risk. That initial 15% is almost like seed money, a shared investment to get the detailed planning and regulatory work going. It buys that early momentum. But notice, NuScale holds back the really big money, that 50% for the module itself, until the PPA is locked in. So they are balancing incentivizing the start against protecting the bulk of their capital. The structure pushes the major market risk onto the utility partner once they sign that PPA at milestone 2.
Okay, that structure seems quite deliberate then, designed for volume. Is this same kind of aggressive, structured approach visible internationally? Let's talk about Romania, the RoPower Doicești project.
Yeah, the Romania project is important. It shows adaptability. Here, they're planning 6 NPMs on the site of an old coal plant. Now, the presentation doesn't break down the funding into those exact 3 milestones for Romania, but the strategy feels similar. Reuse existing infrastructure where you can, make it efficient.
And the source mentions a key operational detail there. The old coal plant itself is entirely removed, but things like the switchyard, grid connection, roads, it's all still there. That must save a lot of time and money compared to a totally greenfield site.
Oh, absolutely. Site prep is hugely expensive and time-consuming for nuclear. Reusing that infrastructure is a major plus. And importantly, this work is already generating revenue for NuScale. They mentioned that the work Fluor is doing on the Phase 2 front-end engineering and design, the FEED study for Romania, that brought in $7.8 million in revenue just in Q3. So the service side of their business is active, even before modules are shipped.
Right, the service element. That brings up another point they emphasize, their licensing expertise. They're really positioning themselves not just as hardware providers, but as critical partners for getting through the CCOLA process, the combined operating license application. Why is that service piece so strategic?
Because getting a nuclear plant licensed, especially navigating the NRC in the U.S., is, well, it's a beast. It's incredibly complex, time-consuming, expensive. NuScale's argument is, look, we already went through the ringer getting our design approved. We know the process inside out. Our technical knowledge, our licensing experience makes us uniquely qualified to help customers get their specific site license.
So they're selling their hard-won regulatory knowledge, basically.
Exactly. And it's a full package. Developing the licensing strategy, actually preparing those huge QOLA documents, and then, crucially, helping the customer deal with the NRC during the review. Strategically, it's smart. It creates a high-margin revenue stream long before manufacturing ramps up. It helps ensure consistency across projects, which investors like, and it keeps them deeply embedded with the customer.
Okay, but all this, the TVA scale-up, the international work, the licensing support, it all requires serious capital to execute. Which brings us to segment 4, the money. Big headline here. A major boost to their cash position in Q3. And the driver was their at-the-market program, their ATM. They pulled in a staggering $475.2 million in gross proceeds in just one quarter.
Yeah, almost $500 million. It's a huge number.
So for listeners who maybe don't track market mechanics daily, what exactly is an ATM program? And why might a company like NuScale prefer that over, say, a single big stock offering, especially given the market is still, as we said, not yet established?
Right. So an ATM program lets a company sell shares directly into the market over time, usually through a broker at prevailing market prices. It's different from a big one-off secondary offering. The advantage?
Yeah.
Flexibility. Especially in a potentially volatile market for a new technology. They can sell shares when they need cash and when market conditions look decent, rather than being locked into one big sale at potentially a bad price. It can also minimize the dilution shock compared to flooding the market with shares all at once.
So it gives them more control over timing and price.
Pretty much. And raising nearly $500 million that way, it does signal significant market confidence, or at least appetite, for their stock and their story, especially with that huge TVA deal announced. It resulted in a very healthy cash position. As of the end of September 2025, their total liquidity, cash, short-term, long-term investments was sitting at $753.8 million.
That's a solid cushion. You definitely need that kind of financial staying power. If you're signing deals that rely on milestones years down the road, you need to fund the R&D, the regulatory work, the early supply chain stuff.
Exactly. And just to complete the picture on Q3 financials, revenue was $8.2 million, mostly from those service fees, like the Romania FDEED study work we mentioned. And yes, raising all that capital did mean more shares outstanding. Total fully diluted shares went up from about 294.5 million in Q2 to 307.4 million in Q3. That's the trade-off for securing that massive funding. Dilution happens.
Okay, so let's try and tie this all together, synthesize the main takeaways. We've got, number one, just the sheer unprecedented scale of the 72-module TVA deal in the U.S. Number two, this very deliberate, milestone-based payment structure designed to manage risk and hopefully speed things up. And number three, a really strong financial position. Over $750 million in liquidity, giving them the resources to actually try and execute these ambitious plans.
Yeah, it certainly paints a picture of momentum, confidence even. But this brings us back to that critical thinking point for you, the listener. While the strategy looks solid on paper and the funding seems to be there now, you always have to layer in those caveats, especially for a market this new. The presentation itself includes those mandatory warnings, and they're not just boilerplate. Success still depends heavily on stuff NuScale doesn't fully control. We talked about liquidity strong now, but future capital needs are huge. There's ongoing competition from other SMR developers. Nuclear energy always exists in a politically sensitive environment. And the big one is the overall market for SMRs truly established yet, beyond these initial flagship deals. These are the big real-world variables still in play. They've got the plan and the cash, but the execution into that volatile environment is the massive challenge ahead.
And that really is the core complexity, isn't it? It's not just about having a good reactor design. It's about navigating finance, politics, competition, and supply chains, all while deploying a fundamentally new energy technology at an industrial scale. Lots to watch.